Investors may be getting a whiff of stagflation following Friday's jobs report, which showed stronger than expected wage growth and weaker than expected employment growth. That's at least what Jim Grant says. He is the founder and editor of Grant's Interest Rate Observer. He joins us on set right now. And Jim, a lot of people looked at that number and thought, oh, good, it's not too hot, not too cold. But I think you make some valid points when you say, look, the jobs numbers were lower and the average hourly wages component was up.
Yes, and a little bit of just a spritz of the late 1970s. It wasn't terrible, but it underscores the difficulty of the degree of difficulty of the Fed's job now. It reminds me a little bit of Captain Sully on the Hudson. It requires a great deal of precision and not a little luck to do what they say they will do, which is to deliver us from the consequences of 10 years of artificially low rates.
They're doing this, trying to get the rates set at the right way, while also trying to launch QT, quantitative tightening. That didn't work so well 4 years ago when they tried to do it, and Jay Powell even kind of pointed to that in his testimony before Congress. Yeah. Well,
the Fed's balance sheet is very much like the late Silicon Valley's balance. I guess Silicon Valley is still with us, but it's very much resembles the balance sheets of the banks that didn't make it through March, because they have an immense mark-to-market loss in excess of $900 billion as of March 31st, and they are losing substantial amounts on operating, just in operations. So their losses are far greater than their capital. So the Fed itself is a symbol of the difficulties of the world in which rates are now being normalized. The Fed says that this doesn't matter, but its accounting is at pains to obscure it from the world. It's not exactly a practical problem, but it is a highly important symbolic one. And I think the world in its adaptive way is coming to grips with the fact that interest rates have been not only low, but have duplicitous. They have led people to do things they wouldn't have done if they only could have known where real rates would wind up, meaning legitimate market-determined rates.
All of these problems with the Fed, though, haven't really played out at all in the market. If you looked at what's happened for the year to date, it's been an incredible run, and it's surprised a lot of people. We just had Tom Lee on earlier this morning. He's been right on his market calls through this, and he's still looking for higher numbers for the S&P at the end of the year.
Yeah, could be. Well, there's something called the Chicago Fed Financial Conditions Index, which is a great aggregation of little indicators, and it says that financial conditions are easy after all of the talk, after all of the rate lifting. So there's a difference, as someone said recently, between tightening and tight. And by the standards of the Volcker era, certainly monetary policy is not yet tight, and yet there are undeniable signs of stringency throughout finance. Not so much in the valuation of NVIDIA at 40 times revenues, but certainly with respect to, say, the coverage ratios in the speculative grade bond market. Those companies are covering their interest charges at a much narrower rate level than they had been in 2022. There are a record number of bankruptcies going back to 2010, corporate bankruptcies in the first half of this year. So rivets are popping kind of off stage. And the question for the Fed, the question for all of us is, will the consequences of these rates now playing out in these examples of stringency, will the consequences overwhelm the Fed's attempt?
Well, that's what I was going to say. Do you think that this is a replay of 2008, where things looked okay for a while after Bear Stearns, or
well, 2008
we came back in the fall and everything collapsed again financially, or do you think that this really is Jay Powell as Captain Sullenberger?
He's a nice guy, Jay Powell, but I think he is not Sully. And 2008 is, I think, it's an unduly provocative analogy just now. I'm not sure it's
I just mean in terms of the financial problems abating and then coming back.
Yes, I think that analogy exactly holds. Nothing. How often have we seen things that didn't appear to matter suddenly mattering? So I expect that we will.
Jim, is there any way that given what happened at zero for financial crisis all the way through the pandemic, is there any way that we've had some pain in the last 18 months, 2 years in the averages, right? And the economy and everything else? Is that enough? Is that enough to to correct the excesses of the Fed over the last 10 years, do you think, or do we have more? I'd be surprised if they orchestrate this nice soft landing and everything's great.
Yes, I would be surprised too. I confess that's partly my temperament. I'm just not equipped to concede the Fed might, in all of its error-laden ways, finally stick it.
That's what
something like.
You know what, though? The consensus is they could never do it. And maybe against consensus, maybe then they do.
So many birthday candles have I blown out that I rule out nothing.
Yeah.
So, yes, it's possible. I think that the distortions created by these rates and by the expectations of Fed intervention have been so widespread and so deep that it's highly unlikely this is the extent of the correction for those things.
I know, but you're a worrywart.
I am. Well,
I know.
it's a job, Joe.
I know.